Good morning, everyone, and welcome to our Creston Reeves Roundup and Q&A on the Autumn 2021 budget. I'm Jennifer Williamson, a partner at Creston Reeves, and I will be chairing our session today. I'd just like to start by saying we're delighted to have so many of you join us. So just a little bit about Creston Reeves before we dive into the budget detail. For those of you who don't know us, we're proud to work alongside our clients to help them achieve their goals, both in the UK and internationally through our Creston network. And if you'll just indulge me in a moment of shameless self-promotion, we were delighted to be recognised for the support we give our clients when we won Large Firm of the Year last week at the Accounting Excellence Awards. That's real testament to the outstanding work delivered by over 500 people in our KR team last year. So now would be an opportune moment for me to hold up that award for you all to see, but it is currently being repatriated to us from a bar in London, where it was last seen with the team celebrating our win. So this was Rishi Sunak's third budget, and in contrast to his budget from March this year, the mood was particularly upbeat because it appears that although things have been tough, Rishi has had more in his fiscal coffers than was being predicted. And he made the choice to spend, spend, spend rather than cut taxes. So higher than anticipated growth in the economy, combined with higher inflation, as well as previously announced tax increases, gave Rishi a whopping extra 50 billion. And he spent around 30 billion of that with the measures he announced on Wednesday and earlier in the year. And he's used the rest to reduce borrowing, to start lowering our national debt. But let's not forget that it's already been a pretty big tax raising year for the Chancellor, starting with his announcement about the increase in corporation tax in March this year, followed by the national insurance increase and health and social care levy announced in September. Our experts will be giving you a reminder of these measures in just a moment. Now, these increases mean that the Chancellor raised more in tax in this year than in any other year since 1993. And it actually took two Chancellors back then to raise this much tax. The OBR say that this has taken the tax burden from below 34% to above 36% by the end of the forecast period, which is the highest level we've seen in this country since the late 1950s. So let's take a look at the newspapers and some of the top headlines since Wednesday to give you a flavour of the wider reaction to the measures that have been announced. The Times ran with the headline, Sunak's spending spree, saying that an extra 150 billion has been announced for public services, with public spending going to its highest level since before Margaret Thatcher. Champagne for the rich, real pain for the poor. The Daily Mirror referring to the tax cut on bubbly whilst the cost of living is set to soar. Big spender Sunak takes the tax burden back to the 1950s. The Eye reports that Mr. Sunak took advantage of an economic upgrade to raise state spending in every department, but it says that whilst universal credit cuts have been scaled back, rising inflation is forecast to wipe out projected wage increases next year. A budget that is gambling with the climate crisis. The Guardian is critical of the failure of the government to invest in the UK's green future, highlighting the announcement to halve taxes on domestic flights just days before the UK hosts the crucial COP26 climate summit. So we'll be spending the next hour talking you through the headline implications from the budget, providing you with a recap of some of the measures announced before Wednesday, as well as setting out the winners and the losers from the budget. We're going to follow this with a Q&A session when you'll have the opportunity to have your questions answered by our panel of experts. So to introduce our panel of experts, we have Daniel Grange, our Head of Tax, Lawrence Parry, our Head of Corporate and International Tax, Andrew Tate, our Head of Restructuring and Transformation, Jo White, our Tax Director, and Lee Hayward, our Financial Planner. Now, if I can just start with some housekeeping. This webinar is being recorded and a recording will be sent to you all later in the day. IT permitting, we'll be asking you for a bit of interaction by taking some polls throughout the presentations, and we'll be sharing the results from those polls with you when we send you a copy of this webinar recording. There will be a pop-up survey at the end of our session today, and we'd be really grateful if you could spare just a couple of minutes to provide us with some feedback. And your questions will be answered by a panel of experts after the presentations. So if you have any questions that you'd like answered, please submit your questions via the questions box. Now on screen now, you'll be seeing instructions for how to raise a question, which we'll just leave there briefly whilst you familiarise yourself with that function. So we're going to say goodbye to our panel of experts for now until the Q&A session later. And I'll pass you over to Lawrence Parry now to provide us with a recap on the announcements that have already been made in the lead up to this budget, as well as the winners coming out of the budget from Wednesday. Over to you, Lawrence.
Thank you, Jen. Good morning, everyone. As Jen said, we've had the budget back in March, and we had the announcement in September about the increase to national insurance and dividend tax. So just running through those, it is been very much a game of two halves, or even 3/3 by the time we've had these announcements. It's the largest tax increase in living memory. As you can see on screen, I've got quite a lot of living memory, and this is the biggest in my lifetime. Corporation tax is back up to 25% from 19%. Small companies will still pay tax at 19%. This comes in 2023. So all the rules we got rid of in terms of small companies, associated companies, closed investment holding companies, they're all back in. The actual big cash increase is in national insurance, both employees and employers, and the equivalent on dividends, but as many said, not on rental income. The other big tax increase that the chancellors hope we won't notice is the freezing of allowances, the freezing of bands. The personal allowance will stay at 12,570 for the next few years, till 2026, I think it is. Similarly with the lifetime allowance of pensions, similarly with the way you kick into higher rates. And if we're getting inflation at 4%, potentially 5%, then actually we're going to be paying that much more in tax each year as income grows, but the bands don't move along with it. The other big increase in tax that will come along in the next 15 to 20 years is inheritance tax. The inheritance tax nil rate band has been frozen for many years now, £325,000. There is an extension for houses, and which takes a married couple, civil partners, up to £1 million between them, but only if your estate's a certain level. But with the rapid increase in prices over the last 25 years in the southeast of England, there is going to be a really big windfall of inheritance tax that comes in as the current generation pass away. And this is factored into the government's inheritance tax goes up £1 billion every year and then increases thereafter for the next 5 years. So that's all the bad news was leading up to the budget. I now have the good news, the great opportunity, almost like in Bake Off. I'm the one that has to do the Star Baker announcement. Dan coming later, he's the one that has to tell somebody who's to leave. So the bit winners, and it's winners from the budget, not necessarily winners overall, because we've seen smaller retail and hospitality businesses will have their business rates cut. Business rates are being reformed to give people a 12-month deferral in terms of their amounts, as is capped at £110,000. Alcohol producers alcohol duty is being reformed. Jen said the headline for champagne rather than for and beer duty will be improved. So Pubs, again, reduction to 3p, we think, on a pint of beer. For Kent and Sussex wine producers, mainly in sparkling wines, that's going to be about 60 to 70p a bottle reduction. So all these things will feed through into helping these businesses continue. But we know that these businesses have been really badly affected by supply chain issues, recruitment issues, and the like. And Dan will cover some of the negative bits later on. There is a big increase to the museum, galleries, the creative industry reliefs. These have been doubled, and from effectively today until 20, and then for the next year, and then slowly reducing thereafter. I mean, it's a bit like the sort of the fish descaler in a Swiss Army knife. For those businesses who it applies to, it's really, really, really helpful. By definition, it doesn't apply to that many, and it's relatively complicated as well. One of the big changes was the families sort of receiving universal credit, and the taper, the withdrawal of universal credit, is going down from 63 pence in the pound to 55 pence in the pound. But the analysis, as people have worked through it in the last 36 hours, shows that it's really only those who are in work who will benefit, and even then only some. And the £20 a week reduction is about £6 billion saving. This is putting £2 billion back into it. So most who will receive universal credit will not be better off. Research and development, again, is being changed and reformed. So big issues over the last few years for software and IT development is that cloud computing and data costs have not been allowed to be one of the costs. And remember, if you're an SME, you get, for every pound you spend, you get an additional £1.30 deduction. If you're a large business, you get 13% reduction of your tax bill. So that's a really big change and a really big improvement. It's not all good news though, and Dan, when he comes on to do the losers, will pick up some of those other points. Annual investment allowance has been extended for until 2023, and this has gone up and it's gone down over the last 15 years. It's an allowance where you get 100% tax relief on your plant and machinery, on your expenditure on equipment, really helping business investment. But we've also got the 130% super deduction at the moment for the same period. So this extension to AIAs is really important for those businesses that don't qualify for the super deduction. The super deduction is defined as only applying to companies. So if you're hypothetically the large firm of the year who's looking to invest in new tech, new IT, improving our property footprint, then actually the extension of the AI is really, really, really very helpful. So we were very pleased by that announcement. So that's the end of my summary of the winners. I'll pass you back to Jen now, who I think's got our first poll question.
Thank you, Lawrence. So yes, we'd like to ask you our first poll question now. Do you feel the budget has left you as an individual better or worse off? The options are better off, worse off, or you don't know. If you just take a moment to fill in that poll for us, that would be great. Thank you. Thank you very much, everyone. So next, to highlight those who will feel they're losing out as a result of Wednesday's budget, I'll pass you over to Daniel Grange. Over to you, Dan. Right, I'm afraid we must be having a bit of an audio issue there. We can't hear Dan, so I'm just going to interrupt that and see if we can get that working for a moment. I think whilst we're doing that, see if we can get the audio working, we'll move on to our next poll question and ask that for the moment. Just waiting for that to come up on screen for you whilst we sort the audio. So do you feel that the budget will leave businesses better or worse off? Better off, worse off, don't know. If we can ask you just to fill that in for a moment.
And whilst that's happening, can you now hear me?
We can all hear Dan, great. So I think we'll return to the budget losers. Thank you very much, Dan.
Sorry about that, everybody, and thank you, Jen. Good morning, everybody. Following Lawrence's reference to the bake-off, I now have the horrible job of explaining who's going to be worse off during the budget. And starting with the climate and the green agenda, which Jen mentioned earlier. As the Guardian headline yesterday stated, this was a budget gambling with the climate crisis. Despite the target of the UK being net carbon zero by 2050, and COP26 starting in just a few days, there were no changes to encourage business or households to achieve this goal. In fact, the opposite's true, with no increase in duty on petrol and diesel to encourage motorists to use their cars less or convert to electric, and there was a reduction in air passenger duty within the UK, which may be seen to encourage domestic flights. So despite the green agenda and the promise of a green economic revolution, we did not see this in Wednesday's announcements. Moving now on to employers, and Lawrence has already reminded us about the 1.25% increase in national insurance for employers as well as employees from next April. This, coupled with the 6.6% increase in the national living wage from £8.91 to £9.50 per hour, gives an almost 8% increase in costs for employers paying staff at the national living wage. And in a large number of cases, this will put a real squeeze on businesses. For example, in the social care sector, where fees are set by local authorities. And this is likely to lead to higher costs and therefore inflation in other sectors as businesses, where possible, try to preserve their margins. A new tax charge was announced on Wednesday for large residential property developers. And with effect from the 1st of April next year, they will see an extra 4% tax charge on profits for residential development where annual profits exceed £25 million. This is unlikely to have a direct effect on a significant number of our developer clients. However, it may well affect our landowner clients who are selling their land to those larger developers. This tax rise could have an indirect impact on the value of the land as the developers try to preserve their post-tax profitability. Moving now to research and development, and Lawrence has already talked about R&D and the positive changes that were announced earlier in the week, with the extension to include cloud computing and data costs. But it's not all good news for those undertaking R&D. The R&D tax relief regime is designed to encourage investment in R&D in the UK, but the Chancellor believes this objective is not being fully achieved. And that's because currently some UK businesses have overseas subsidiaries that undertake R&D work on their behalf. And they can claim this enhanced UK tax relief on those costs as if their subsidiaries were subcontractors. And so they're benefiting from UK tax relief on R&D activities being undertaken outside the UK. From April 2023, the relief will be more focused on supporting innovation within the UK. We expect this to be achieved by subcontractor costs only qualifying for relief where the subcontractor is based here in the UK. We don't yet have full details available, but if this could affect you, please do keep an eye on our website for updates as further detail becomes available. And finally, as is always the case with the budget, there's a lot of detail that isn't mentioned in the budget speech itself. But there are a couple of points here that I think are important to cover. Firstly, a change to pensions. Currently, as a general rule, you have to be at least 55 to take benefits from your pension, for example, your tax-free lump sum. Otherwise, you suffer a penalty tax charge. From April 2028, you'll have to be 57 to take those benefits. We'll need to wait for the detail of these changes to see what impact this will have, for example, on people who turn 55 before April 2028, but don't take their benefits until later. And finally, a really significant change for the self-employed. And whilst the Chancellor did not announce this in his budget speech, there's going to be a fundamental change in the way in which the self-employed are taxed. And this is perhaps the biggest change in the tax treatment of the self-employed since the introduction of the self-assessment system back in the mid-1990s. The change is being made to the basis period rules. And these are the rules that determine which profits are taxed in which tax year. When I talked about the self-employed, this includes partners in partnerships, members of limited liability partnerships, as well as sole traders. So at the moment, we operate what is known as a current year basis, which means the tax is based on the accounts year that ends in the relevant tax year. So if you have a 31st of May year end, the profits for the year ended 31st of May 2021 will be taxed in the current 2021-22 tax year. And there are special rules in the opening years which can result in some of the same profit being taxed twice, and this creates what are known as overlap profits. These are carried forward and released when you cease to trade, for example, on retirement, or if the business's year end is changed. Under the new rules, everyone who is self-employed will be taxed on a tax year basis. So that's the financial results for the year ended 5th of April, irrespective of their actual accounting year end. So I think it's really important to highlight this will not affect you if you already have a 31st of March or 5th of April year end. But if you have a different year end, it really could have a significant impact. The announcement from the government stated that the reform is to create a simpler, fairer and more transparent set of rules for the allocation of trading income to tax years. But it must really be linked to the introduction of Making Tax Digital, or MTD. So as many of you will be aware, MTD is already in place for VAT. But MTD for self-assessment is due to come in April 2024. And that will require businesses to provide data to HMRC digitally on a quarterly basis. An MTD really would not be possible or effective if accounting and tax years were not aligned. You can find out more about MTD, your obligations and how we can help you on our website. There is an added benefit to these changes for the Treasury as it accelerates the payment of tax on profits. I think it's fair to say that in due course, we would expect almost all businesses to change their year end to the 31st of March or the 5th of April. So how's this going to work and what's the change going to mean? Well, we're going to transition to the new rules in the 2023-24 tax year. And from 24-25, the new rules will be fully in place. In the transitional year, an extra slice of profits will be taxed to align with the tax year. And any brought forward overlap profits will be offset. Under these transitional rules, any excess profit that is created in 2023-24 tax year will be spread over a 5-year period to smooth the impact. It's worth noting that if it's beneficial to you, you can elect not to spread that excess profit over 5 years. And the change to these new rules will accelerate the payment of tax and may result in higher tax bills for some people. But as I said earlier, this won't affect you if you have a 31st of March or 5th of April year end. So these rules are quite complex, and I think the easiest way to explain them is by way of an example. So you can see on the slide that we've got an individual who has a 31st of December year end, and they're making annual profits of £100,000. They have overlap profits, those profits that were taxed twice when the business started, of £5,000. If things were going along as normal, in the 23-24 tax year, they would normally be taxed on the profits for the year ended 31st December 2023. But under the transitional rules, they'll be taxed on those profits, the £100,000 for the year to December 2023. But we then also have to look at an extra 3 months of profit from the 1st of January to the 31st of March, which is £25,000, and we can take off those overlap profits they have brought forward, the £5,000. So we've got excess profit of 20,000, and that's divided by 5 because of the spreading and added to the taxable profit for the year and subject to tax in the normal way. So that gives this individual taxable profit for the year of £104,000. This takes their income over the £100,000 threshold, and that means that they start to lose their personal allowance at the rate of £1 for every £2 of income over 100,000. Due to the loss of that personal allowance, the income over 100,000 is taxed at an effective rate of 60%. And that means that the extra tax on the excess profits of 20,000 over 5 years could be £4,000, compared to if the rules didn't change. And that's in addition to accelerating the payment of tax. I think it's worth flagging that it may be possible for this individual to mitigate the impact of these new rules, for example, by making personal pension contributions and so retaining their personal allowance. It's not just those people who are near the £100,000 threshold who could face increased tax liabilities. This could also apply if you're near the higher rate threshold, near the higher income child benefit threshold, or near the additional rate tax threshold. It could also, if you're a high earner, affect the amount that you can put into your pension on an annual basis. So if you're self-employed, we'd really recommend that you plan ahead, get an understanding of the impact on your tax position and future cash flows, and consider what can be done to minimise the impact. And we'd be very happy to help with this. Thank you for listening, and I'm now going to hand back to Jennifer.
Great, thank you very much, Dan. So we have one final poll question for you, which is a multiple choice question. After we've done this, we'll move on to your questions. So our final poll question for you is, has the budget announcement caused you to reconsider or explore any of the following? Pension funding and or retirement planning, personal finance plans, property plans, research and development tax credit, or remuneration strategies? We'll give you a moment to answer that poll question for us. Wonderful. Thank you very much, everyone. So the questions have been coming in thick and fast whilst our speakers have all been giving us their wisdom. So please do continue to submit them. If we're not able to answer all the questions today, then one of our experts will follow up with you after the webinar to cover your query. So let's go to the questions. So we'll start with a question that's come in from Susan. Jo, I'll direct this question to you first. With the dividend rates and corporation tax rates increasing, is it still worthwhile running your business through a limited company?
Thanks, Jen. As is with most things with tax, the answer is pretty much it depends. It depends on a number of circumstances. So if you look at the tax rates alone and you're on a full extraction model, then the answer is it probably isn't as beneficial as it once used to be, especially with the rates rising. However, there are a number of benefits for a company. For example, you can plan your remuneration more easily through a company. So if you don't need to extract all the profits in 1 year, you can take them over a number of years, which can minimise the use of your tax bands. And as Dan mentioned, in the context of the changes in basis period, that means that you could restrict your income to less than £100,000 to preserve your personal allowance, £50,000 if you're claiming higher income benefit charges, etc. From a non-tax perspective, there are also commercial benefits. So people like working with other companies. There is also limited liability within a company structure. So depending on your business model, depending on your exit strategy longer term, and certainly your income needs, the company may still be beneficial.
Thank you very much, Jo. Dan, we've got a question that I think I'll direct to you next. This question's come in from David. He's asking, were there any changes to capital gains tax or inheritance tax in the budget?
Thanks, Jen. No, there weren't. You may recall there was a lot of noise in the press back in March, before the March budget, about potential increases in capital gains tax and aligning rates with income tax. That didn't happen. As Lawrence mentioned, the tax-free capital gains tax annual exemption has been frozen until 2026, so we're not going to see any changes there. And likewise with inheritance tax, no changes, and the threshold has been frozen again until 2026. That threshold will have been the same since 2008, and I think it's interesting that if you had a house worth £325,000 back in 2008 in the southeast, it would now be worth nearly £500,000. So a 53% increase in value, but without a corresponding increase in the tax threshold. So as Lawrence said, we're expecting to see a big increase in inheritance tax take over time as those property values filter through into the inheritance tax money for the revenue.
Thank you very much, Dan. We've got a question now about help for the high street. Andrew, I think I'll direct this to you. Did the Chancellor do anything to help the high street? That's coming from Anne.
Thanks, Jen. The retail sector was obviously hit very hard during COVID, and hopefully is recovering, but is also being hit by the supply chain issues. So the government did two things for retail. One is an extra cost for retail, unfortunately, which is the national living wage, rising from £8.91 to £9.50 an hour for those aged 23 and over. Obviously, with rising inflation, that's a very fair thing to have done, but it will increase costs for business. The other aspect is business rates. So there's been a lot of criticism of business rates over the past few years, and so the Chancellor announced a temporary 50% cut in business rates for retail, hospitality, gyms, businesses like that. 50% cut in business rate up to a maximum of £110,000. That's just for the next year, which is actually one of the few pandemic reliefs which has been extended. The other thing that the government has said is that the rating system would be fairer and timelier, with basically revaluations of property every 3 years. So you don't have a situation where you could be sitting on a property which is revalued to an enormous extent, and then you've suddenly got a huge additional rates bill.
Thank you very much, Andrew. Lawrence, we've got a question I think I'll direct to you next. It says, I saw a headline about it being easier for US companies to invest in the UK. Is that right? And what is the impact?
This is actually, the answer is yes. And if people want to switch off now, that's absolutely fine, because the answer is yes. There's a bit of detail behind it, because the US has a really flexible tax system. Unlike the UK, who has companies that and you have self-employed people, in the US you can elect to be treated as self-employed when you've got a company, and vice versa. It's called checking the box. It is, you tick a box, and it's all. And one of the things that's happened over the last 10 years in international tax is countries, generally led by the UK, have tried to get together to stop the worst abuses in international tax. And one of these abuses is where you've got one country treats a entity as a company and another country treats it as partnership, and both countries get tax deductions, or it falls out of tax both ways. So we introduced rules back in 2015 to say, well, you have this situation, you can't get a tax deduction. Now, with all US businesses checking the box, this creates real issues for US businesses investing in the UK. And the government announced back in July, confirmed in this budget, that in this particular situation, where it's only because they're transparent in the other country, these rules won't apply. Very, very helpful for US businesses coming into the UK.
Thank you very much, Lawrence. Lee, we've got a question that's directed towards retiring and pension changes now, so best placed with you. This is coming from Graham. I'm looking forward to retiring and heard that there were some pension changes in the budget. Will I be affected?
Okay, well, thank you very much, Jen, and good morning, everybody. Well, the good news is that it is still possible to retire. There was no mention that privilege will be taken away from us in the budget on Wednesday, so there's the good news for you. And in truth, pensions were left pretty intact, which makes a very pleasant change, although there has been a little bit less on pensions, I suppose, in more of the recent budgets. There was no levelling of income tax relief on contributions, which is one of the things that the press always tend to pick up on. So if you are a higher rate taxpayer, additional rate taxpayer, you will still benefit from your 40%, 45% tax relief on pension contributions. The key changes that really came out of the budget on Wednesday, as far as pensions were concerned, surrounded the normal minimum pension age, which is increasing, as Dan mentioned earlier, from 55 to 57. That's the age at which you can take benefits from your private pensions. And there were some other sort of less significant changes, I suppose, around potential review of the charging cap on workplace pensions, which you'll be familiar with either because you're members or because you have, as business owners, got workplace pension schemes for your staff. So the question really relates, of course, to somebody coming up to retirement. So the former being more relevant, I'll cover that one here, and if there's anybody wants any more general information on some of the less important, perhaps, pension changes, I'm happy to cover those as well separately. So the impact will really depend on when you were born, ultimately, as far as private pension age increases from 55 to 57, and of course the state pension, which is increasing as well. At present, you can access your pensions, as we say, private pensions from 55. So from the 6th of April 2028, that's the 6th of April 2028, for anyone wanting to make some notes, this will increase to 57. So if you were born, let's chuck a few dates out there. If you were born before the 7th of April 71, this isn't going to be of particular concern to you because you will already be 57 years old at least, and you will therefore not be able to access your pensions until you are 57. If you were born between the 7th of April 71 and the 5th of April 73, you are likely to be affected if you still have pensions to take on the 6th of April 28. So it really affects those that were maybe looking to retire at the earliest opportunity with their private pension provision. If you're unfortunate enough to reach the grand old age of 55 on the 5th of April 2028, the day before the rules change, you will have a 2-year wait, basically, before you can actually access your remaining pension benefits. So state pension, I mean, just very quickly to touch on the fact that if you have got existing pensions, some may contain clauses which do permit you in the policy rules, basically, to take your pension before the age of 57, and that is something that we can check for you to see whether that is an entitlement that you have as a result of the scheme rules or the policy provisions. And when we are looking at pension transfer business, which we do quite a bit of, that is an important question that we're asking the providers to confirm now, whether you have something called an unqualified right to take benefits pre-57. So there might be some plans out there that allow you to still take your benefits at 55. State pension age for all of us now is 66, so worth mentioning that. And this is going to increase to 67 between 2026 and 2028. So that will affect any of you born out there after the 6th of April 1960. So that's the 6th of April 1960, you will have a state pension age of 67. So that probably covers the answer. I mean, I'm considering myself particularly pensions unlucky today. It's my birthday, but I failed to escape the private pension increase and I fall foul of the state pension increase. So a very happy birthday to me. I feel like I should be raising a glass of low alcohol sparkling wine to toast you all. But that's my answer to that one, Jen. Hope you all have a good morning.
Thanks very much, Lee, and happy birthday.
Thank you very much.
We've got a question in next from Trevor. I think I'll direct this to you, Dan. It says, how will the budget impact freelancers?
Thank you, Jen. I think it depends if you're a freelancer, how your business is structured. So if you're a self-employed freelancer, then the basis period that I talked about earlier could well affect you. So the change in how your taxable profits are determined for each year. So that's something to look out for. And if you don't have a 31st of March year end, that change in basis periods could accelerate your tax payments over the next few years. If you're trading through a limited company, then there weren't any specific changes. Lawrence mentioned the increase in the corporate tax rate to 25% over the next few years, which will have an impact. But there were no changes announced to the off-payroll working or IR35 rules as we know them. So they're, as they have been now for the last 6 or 7 months, where if you are contracting for large businesses, they need to make a decision whether you are effectively an employee or not and deduct tax as appropriate. If you're working for small businesses, then that obligation remains with you as the freelancer under those IR35 rules to decide whether you are or are not caught by them. But no specific changes in the budget this time round.
Thank you very much, Dan. Andrew Tate, we'll just refer back to the question that was asked previously about help for the high street. Someone's asked in particular, do we know if the 50% business rate relief for retail, etc., includes estate agency branches? Do we know that detail yet, Andrew?
I don't know that detail specifically, Jen, but I would bet that it will include estate agency branches. You know, they're part of the high street, and I think that they will be. I'm very happy to check that, though.
Thank you very much, Andrew. We've got a question here from Richard. Lawrence, I'll direct this at you. Richard's asking about the impact on charities. Is the budget good or bad for third sector and charitable organisations? What are your views there on?
Taking the budget, the game of two halves, game of 3/3, since March last year, is actually bad for budgets, bad for charities, because of the national insurance increase, because of the increase in the minimum wage. There's been no changes actually to the taxation of charities. The relief from rates generally doesn't apply to charities because they don't pay. There's a whole range of things that just don't apply to charities, but the actual business costs of running charities are going up. Fuel's going up, employment costs are going up, national insurance is going up. All these things will affect charities just as much as they affect any other businesses. But no change actually on charities in the budgets.
Thank you, Lawrence. Joe, I've got a question I'll direct at you next. This is coming from Clive. Clive is asking, what should we be thinking about as a business when we're investing in bits of kit over the next couple of years?
Thanks, Jen. I think fundamentally it's down to timing. So, I mean, even though the £1 million annual investment allowance has been extended until March 2023, there's still a chance that that may change because it seems to change every year. However, on the basis that it doesn't, it's down to timing and making sure that you're maximising on your spend in each accounting period so that you can get full relief for that AIA. Things to think about there are how you purchase equipment. So, for example, items purchased on hire purchase. The timing of the tax relief depends on when the asset is brought into use if you buy it around your year end. So that could tip you into the wrong accounting period if you accidentally, well, not accidentally, but sign an agreement at the wrong time. So I think it's really important if you're looking at buying significant equipment over the next few years, especially, for example, if you're moving premises as well, that you speak with us to identify what sort of costs you're incurring, when they're likely to be, so that we can ensure that you do sign contracts, etc., at the right appropriate time. For companies also, there's the super deduction allowance, which Lawrence mentioned earlier, so you might be able to benefit from that as well.
Thank you very much, Jo. Lawrence, I've got a question here I'll direct to you. My corporation tax bill will rise to 25% of declared profit in 2023. What rate is applied to Amazon et al., who make far more profit than me?
The short but unhelpful answer is also it's 25%. But it depends on what Amazon pay their profits on, and that's the key point. It's not the rate they pay, it's the definition of profit. So again, reflecting back on what I said earlier about the OECD and their changes to rates, there was a big shift, and they called it base erosion and profit shifting project over the last sort of 10 years. And 3 years ago, they had a big announcement where all the big tax jurisdictions came together to agree some rules. And these anti-hybrid rules that we had was one of those. And what they were doing was try to get the worldwide tax system fit for the 21st century. Because our tax system was designed in the 1950s, double tax agreements, where you basically operate in your own country. So we wanted to encourage businesses to export. So we said, if you've got a warehouse overseas, that in itself doesn't create a taxable presence. And so Amazon, taking advantage of this from the 1950s double tax agreements, set up massive warehouses overseas. And all they did was store the goods that they sold from Luxembourg or they sold from the US or wherever and just delivered them. That doesn't create a taxable presence under the old rules. So 3 years ago, the OECD said, actually, this isn't working in the 21st century. What you really need to do is refresh this. And so one of their projects was looking at these sort of arrangements. And they're now far much more focused on where people actually operate, where you have employees. So for Amazon now, you won't have seen it 2 years ago, you won't probably see it last year, but increasingly they will have increasing profits attributable to their UK and indeed French and German and other sort of countries' operations, because they will have to start paying more debt. What they define their profits will go up. I can also talk about Google and how they operate, but I'll leave it. If somebody wants to ask a question about Google, I can talk about that one as well. But we'll take from there, and indeed Starbucks. So.
Oh, thank you, Lawrence. I think we'll leave Google and Starbucks for now, but you heard it here. Amazon are going to start paying more tax. So, Dan, we've had quite a few questions in around the item you talked around about changing basis periods and how that might affect the self-employed. But summarise those questions. People are really asking, what should they be doing to prepare for that now?
That's a really good question. I think the key thing is making sure you know what your year end is. So if, as I said earlier, if you've got a 31st of March, 5th of April year end, these changes are not going to affect you, so don't worry. If you don't have a 31st of March or 5th of April year end, the key thing is to look forward and be projecting what, as accurately as possible, what your profits are likely to be over the next few years. The other key thing is to make sure you know what your overlap profits are. So as I said, those were created when you started to trade, or if you've been trading since before self-assessment came in, they will have been created when self-assessment came in, which I don't remember, but I think was about 96, 97-ish. So no, Lawrence is nodding, so that must be about right. So some of this data is really, really old, and trying to capture that and find that is really important. So tracking down what your overlap profits are is really, really important. And we can then have a look at what your expected profits are going to be in 23-24 tax year, and then think about planning around that. So I talked earlier about potentially pension contributions, gift aid, other things like that. Joe was talking about capital investment. If you're going to make significant capital investment, timing that so you get your tax deduction, your annual investment allowance in the right year, so you get the maximum relief, is going to be absolutely critical. So I think it's trying to get as much visibility of what those future profits are going to be, capturing the data about your overlap profits, and thinking about what your future capital spend looks like to make sure you get maximum return on that for you.
Thank you, Dan. I know, Lawrence, you've probably got some thoughts you want to contribute here as well.
Yeah, I mean, I've read the impact assessment on this particular measure this morning coming into this, knowing Dan was going to talk about it a lot. The government thinks there's about 530,000 self-employed people who will be caught by, who will be, in theory, affected by this measure, depending on their year end. Their impact assessment, because every budget measure has to have a costing, how much it will affect in admin terms, estimates that it will be a £10 million cost to make this change. I think that's a vast underestimate in terms of explaining to people what this means. Because if you ever got a 31st of March year end, this is, you've seen the calculation that Dan set out. We've got 50 partners. We've got to explain it to all of them. This is going to be a nightmare. All LLPs, legal firms, architects practices, everyone who is self-employed will have these costs and will have to be speaking to their accountants about it. If they're unrepresented, they've got to try and work this through the HMRC system. That is going to be a nightmare. £10 million is a drop in the ocean for what this is going to cost. It is entirely necessary. If we're going to have a digital tax system, you have to have a 31st of March year end. You just have to. You just can't work otherwise. But it's going to be a big cost and a big change over the next 3 years.
Thank you, Lawrence. Thank you, Dan. We've just got time for a very, very quick question. So, Andrew, if you could keep it brief. Someone's asked, the Chancellor acknowledged that supply chain issues are going to take some time to resolve. Did he put any measures in place to help resolve these?
Thanks, Jen. So yes, the Chancellor did mention this. He didn't provide any magic solutions, but he did acknowledge that supply chain issues are really hitting our economy at the moment. He did take some positive steps relating to HGV, though. Obviously, that the lack of drivers has been a problem for us. He froze the vehicle excise duty rates for HGVs for next year, and that was really helpful. And he suspended the HGV levy, which is a further tax on HGVs for road wear and tear, and he suspended that for a further 12 months. So again, some pandemic reliefs that are continuing there. He also said that he's going to be investing about 32.5 million into HGV roadside facilities, which will be really important to encourage new people to come into the haulage sector.
Thank you very much, Andrew, and thank you everyone else for those insightful answers to our questions. I do acknowledge that we haven't been able to answer all your questions, so we will be getting in touch with those of you who we haven't been able to answer your questions today to follow up. If you do have any additional questions or matters that you would like to discuss further with our team, please just leave a brief description of these on the pop-up survey at the end of the webinar and we will be in touch. So I'd also like to take this opportunity to invite you to join us to our Shaping Your Future report launch webinar, where we will be exploring the findings of our research that's been curated from over 650 business leaders. with the aim of helping you plan for your future. That webinar is taking place on Friday the 19th of November from 9 AM to 10 AM, and we would be delighted if you could join us. Joining instructions will be sent to you with the follow-up email from this event, or you can register your place via our website at www.crestonreeves.com/events. So as I mentioned previously, if we haven't been able to answer your question that you submitted today, one of our experts will be in touch with you shortly. There's going to be a short questionnaire that will pop up when our session ends, and your feedback on our budget webinar today would be really appreciated. So whether you're a client already working with us or not, if anything has come out of today that you'd like to discuss further, please do not hesitate to contact us. We'd really be delighted to hear from you. So that leaves me to say thank you very much for joining us. Stay safe, keep well, and goodbye from all of us. Take care.